why also year on year works pretty well with the ISM, and it's currently pricing about 45, which is a recession. Now, so that tells me that we are closer to the end than the beginning of the move. Pain of tightening is already in the market. So the probability is that the other side of a recession where conditions loosen is the thing that eventually gets priced in. So as Sam kind of suggests, is that the markets have now, crypto markets, and I showed that with that M2 chart, have priced in this full thing. So it's already there. Again, the Fed are a kind of noise because it's the actual bond market that does the tightening, not the Fed. So the Fed, wherever they are in rates, is irrelevant because the bond market, pushed it all the way up to 3.6% or whatever it did in 10-year rates, and same at the front end. So I think it's a lot of the bad news, however much that is, whether it's 80%, 90% or 100% is in the price. And Sam sees that from the market clearing itself within crypto. How many of the bad positions have been washed out now as we've seen this kind of long-term capital management style blow up where everybody was lending to the same counterpart, and then when the counterpart goes under, everybody goes under. And I've lived through that before, and we talk about that in the interview quite a lot, about how similar it is to long-term capital management with the Three Arrows Capital blow up and how Celsius is linked to it and everything else. So yes, normally these things are towards the end, aggressively actually. The kind of biggest addition to my crypto bets since 2020 into this. I don't know where the low is. Could a drop in economic conditions cause further short selling or panic? Possibly. I think the low is close. Whether it's in or not, I can't tell. But I know from all of my economic work, and I've probably got maybe 200 charts to back up all of the stuff I showed, that suggest the balance of probabilities are that a lot of this has been priced, that we've got the inflation problem is probably a thing of the past, and that economic growth is going to fall sharply. Now, what happens when economic growth falls sharply is we now have this Pavlovian instinct of the market looking forwards and saying the Fed are going to pause and monetary conditions are going to ease. Now, don't forget that financial conditions index that I showed you, the global macro investor one. Well, that prices in commodity prices and the dollar and yields. So if yields start coming lower, commodities start coming lower, and the dollar eventually tops out, which it's not clear that that's going to happen yet, but at some point it will, then you've got all of those reversing. And that tells you that usually that's when the Fed have started to reverse. The scenario is that I'm wrong, that the 1974 short, sharp contraction of the economy and contraction of markets is not that it's 2001-2 or 2008 all over again. In which case, you get a false rally that goes on for a period of time, and then it rolls over and has another whole set of lows. Those are the 50% sell-off style scenarios. I don't see that in the forward-looking data because I think it looks sharper and shorter than people expect, but that is a possibility. So it's really hard to call in these things, trying to pick lows and stuff is not easy because, many people got carried out in 2002. I remember it really well. Then 9/11 hit and then the whole thing rolled over again and it destroyed people. So these kind of markets are not easy to trade. The bond market tends to be the easier trade, but it's been hard because the inflation story has been so sticky. But when it gets easier, that's an easier place to make money. Could be. But we've got to get through a recession first before we start talking about the next cycle's inflation. Now, does inflation settle down to 3% or 2.5%? I don't know, but I do a chart of 5-year real rates, and they've been declining for 25 years now, and the trend rate of real rates is about -1%. But what Brad is seeing, and Brad has made some programs for us because he is incredibly smart and he's all day in his truck, observing the economic conditions of the United States on the ground, is definitely to do with onshoring. Manufacturing bases, supply lines are changing. I think it's temporarily good for jobs for construction, temporarily good for commodities because you need stuff to build stuff. But if you look at the Tesla factories, and the Amazon factories and the warehouses, the robots are winning. And the robots are very, very deflationary. So, we saw this again after World War II, we had a massive boom, a massive building boom. That building boom actually didn't generate that much inflation in the end. It generated it initially from the supply issues, and then it settled down. What we got was actually decent economic growth. I actually think the backside of this cycle is probably half decent economic growth if this onshoring continues and we get some fiscal stimulus, which I think is needed at a structural level in both Europe and the US. And I think things like ESG, the kind of coalescence of capital around that creates more of a boom because it creates technology, it creates a change of infrastructure, and these are good things. I don't necessarily think they're inflationary. Sure, things like copper could have a real tight spot, but copper, as we've seen, prices in the business cycle first, and copper's been going down like a lead balloon as opposed to a copper balloon. The year-on-year rate of change of oil is identical to the ISM. All assets are. That everything is the business cycle. The business cycle is everything. So therefore, the oil price is likely, not certain, to follow the ISM lower with a lower economy. To Warren's point, demand gets destroyed. It's the rate of change of demand being destroyed that changes the price. Now, and he's right, is the oil market is in imbalance and will be for some period of time. So that tells us that if we do get a sharper fall out of oil because of the economy and demand destruction, and we know that in 9 months' time, maybe the economy bottoms, well, then we should be expecting to then see more constructive prices. And that's pretty normal. Now, again, people conflate the level of the price of oil with the rate of inflation. $100 oil equals inflation. $100 oil does not equal inflation. $100 oil in a year's time will actually lead to negative 20% year-on-year rate of change of oil because it got to $120. So the question is how far does it go, and in what pace does it go in the future? But I think there's a gap between now, with oil market pricing the ISM at about 54, and the ISM going down to 35. Where does that put the price of oil? Does oil price in the full recession? Probably not, for the reasons Warren says, but it still gives us a risky downside that can catch a lot of people off guard because a lot of people are in oil stocks. If I look down the US sectors, pretty much everything's down 20% year to date except oil, which is up 25% year to date in terms of equity sectors. So in a recession, you tend to take money off the table. Those kind of sectors get shot. So just be careful. I understand the long-term thesis. I don't disagree with it. I worry about the from here to there.